Good.
Hey, good morning, everyone. Chris Lopez here, and I'm a real estate agent at YourCast Real Estate, and I focus on helping investors build their rental portfolios and house hackers build rental portfolios. And so I'm doing our monthly roundup webinar for the month of May here in Denver. So what this is I get together once a month. We give a couple quick market updates. We talk some interesting news or stats, and then we go into a couple of case studies. So I've got Joe Massey of Castle & Cook, who is a great mortgage loan officer there. So good morning, Joe. Thanks for joining me.
Chris, great to see you. Appreciate you having me on the show. Always one of my favorite things to do every month is go back and look at what happened last month, where things were at, where things are going. So I really appreciate you having me. It's exciting.
Of course. And we got some, I don't know, this is like one of my favorite things I do every single month. And we've got some fun deals to talk about this month and some fun stats as well. So we already talked about who we are. I'm the guy on the left, Chris Lopez. Joe Massey's on the right. Talk to me if you need help buying a property. Talk to Joe to help finance a property. All right. So we are looking at the data snapshot here for the month of May. So this is pulled from the MLS at kind of like the first week of June. And then we can look at May, the previous month of May then. So what I want to focus on is the active listings to talk about up here. So this is our total inventory. These are what properties are on the market that are available. So they're not under contract, but this is any properties that you, me, Joe, anyone wants to go out there and go get under contract and purchase. So at May, we're about at 8,900 properties for inventory. So that's single family homes, which include like detached properties. So just your standard home, and then condos and townhomes, not your duplexes, triplexes, and big apartment buildings. This is all just the single family stuff. So if you look at a year ago, we were right around 6,400. So we're about a 38% increase. Well, if you've been following the market stats or listening to our webinars for the last few months, you know this has kind of become the norm now. And I mean, it's been going on for what, 8 months or so, Joe?
Yeah, increasing inventory has been going on for a while.
Yeah, I mean, we've been seeing it right around between about 35 to about 50%, month comparing year over year, which we like to look at because that takes into account for seasonality, because looking at properties in May is very different than looking at properties in November. So I kind of consider this, hey, we have higher inventory over the last year. Not really big news anymore is the way I would categorize it.
It's not, but as it continues to increase, it really opens up opportunities for buyers. And I think we're going to talk about this a little bit more as we get into the webinar. Buyers, if you've been on the fence and you've been frustrated, oh man, I couldn't buy anything last year because there was too many offers, couldn't get out to look at properties soon enough. This is the time. This stat right here, this increase of 38% in inventory, that's your opportunity that there's 2,400 more homes this year than there were last year. Get out there and look at them because there might be one you want to buy.
Exactly. And we'll talk some more stats because, there's more inventory. So does that mean the market is changing? We'll dive in that in a few minutes. So something else I want to talk about on here is the under contracts, because I think this is actually the best leading indicator to see, hey, what's happening in the next, month or two after this month happens. So Joe, when you or me or whoever gets a property under contract, what happens? How long does it take to close, actually?
Well, if it's me, it's 8 days.
Yeah.
No, I'm kidding. It is actually only 8 days with us. We offer that service, but it's average 30 to 45 days is the way it works. You get under contract, you got to do your appraisal, you got to do your inspection, you got to do, your various getting approved for the loan, etc. So once you get under contract, generally 30 to 45 days is when you will actually close.
And that's like the market average.
Yeah. It's very
Joe
standard.
Closes fast. We close fast.
Right.
I mean, I can't remember a contract written that's happened longer than 28 days.
Right. We're going to talk about that actually later.
Yeah,
in
we
the
got a
webinar
couple
as well.
like that.
Yeah,
some quick ones.
But the average 30, 45 days, sometimes longer if the seller needs more time. Yeah. But that's what I think where you're going, this under contract, these are the closings we're going to see next month.
Yeah.
Right. So this under contract right here of 50, that's a year ago, excuse me. This under contract of 6,470 right now is going to trickle down here. And next month, a big portion of these are going to be the solds for May. So this sold for May of 5,551. These were the under contracts back in April. So that's an important, leading indicator that there's more transactions happening and under contract now. So there'll be more next month.
Exactly. So, we're recording this in June right now. So next month we're talking about the June data. And I mean, my guess, Joe, is that we're going to see way more sold kind of like June of 2019 compared to June 2018 is my guess.
Yep, I would agree. And one important thing, you're not going to see, just because we're under contract on 6,400 homes right now, you're not going to see all 6,400 of them close in June. Contracts fall out, people get cold feet, things don't pass appraisal, inspection, whatever. So still a very good leading indicator for what's going to happen next month.
And when I'm excited or interested to see as we kind of wrap up, finish up the second quarter here, get some more market data, is actually the actual undersolds for May. So I'm sorry, the properties actually sold in May, about 5,550 properties for May of 2019.
Mm-hmm.
Last year, about 5,900. So about 400 more properties sold last May. Not a huge number, about 6%. But with this increased inventory, and then with the interest rates dropping, I want to see what this, I would imagine sold would go up. So it'll be good to dig into the second quarter data once all wraps up here in a couple months to see what this trend is going on, or what trend is going on, I should say.
Yep, absolutely.
So moving on to the next slide. This is actually...
Can you go back one? I'm sorry.
Yes, sir.
I just noticed right here, close price to list price. For those of you listening that can't see the screen, in May of 19, the average home closed at 99.66%. So if I listed the home for $100,000, I sold it for $99,660. So I was able to get a little bit of a discount if I'm a buyer. A year ago, homes sold at 100.76. So same property listed for $100,000, I was selling it for $100,760. So I think this is just an indicator that buyers have an opportunity to get a little bit of a price reduction, maybe a little bit of a seller concession, and that's a function of this increased inventory. So inventory is up 38%, which gives us an opportunity to get a little bit of a better deal if I'm a buyer. Not tremendous. We're not buying properties 10, 20, 30% off of list price, but a little bit. So I just noticed that as we were going to the next page. I think it's just an important thing to see. Again, buyers, there's an opportunity out there.
Exactly. And I mean, this does not mean great. Go write offers that are 80% on list price. I mean, don't have me write those offers, please, because that's just a waste of time in this current market. But just said, hey, there's no more wiggle room in the negotiation price. And when it comes time for the inspection, objection, and resolution once you're in a contract, that's where so far I'm noticing the biggest difference with the properties we've closed this year is we're getting a lot more concessions.
Yep.
And the sellers are a lot more willing to talk to us on the inspection stuff. And you see a lot more deals on the lending side.
Yeah.
I know. Are you seeing similar trends? Or
100%.
Okay.
I would say... Well, I say 100%, I see more trends. I would say probably 50% of the transactions I see, there's some sort of concession during the transaction, whether the seller's paying some closing costs, the seller's making some repairs, or the price is being reduced. I would say at least 50% of the transactions that I'm involved in, we do see that. Yeah,
and we don't have stats to back it up other than we're just in the trenches every single day, and it feels different, or it is different than it was a year ago and 2 years ago.
Yeah. We got mud and dirt and blood and stuff all over our face because we're working all day, every day, and we see these deals get put together, right?
Yes. All right. So I actually want to drill down into, this is a drill down into the kind of the same data we looked at, but this is that first data we talked about was just the whole single family market. Now this is breaking down it into detached properties. So just your kind of your standard homes that don't share any common walls. And then the attached properties, so condos and townhomes. So for the single family, the inventory is up about 30% from last May. You can see my fancy red highlight there. And then the condo, though, we've seen a 65% increase in inventory. So while we're seeing a 35-50% overall in the market, a large percentage of that's coming from the condos, at least percentage-wise. So that's just a big jump in condos right there. Now, I have not seen enough data yet, nor taken the time to drill down into it. But, you know, we buy a lot of condos in Aurora, Southwest Denver, and these are the lower price condos and investor complexes. I'm not seeing a lot more inventory in that segment of the market. It actually feels like we're seeing less of our usual great rental inventory than I did last year. So I think a lot of this is just the higher end stuff, all the new stuff coming on, the higher price condos. I think that's where a lot of the inventory is growing from, but I haven't drilled in on data. So
I would agree.
Okay.
Yeah. I don't see as many lower priced homes coming available or lower priced condos, but I do see more condos. But again, maybe if I'm a house hacker, I'm not looking for a $140,000 condo in Aurora. Maybe I'm comfortable with a $280,000 condo in Centennial.
Yep.
Right. So those are out there. They're available. And that's what this is indicating. This 65% increase here. big opportunity to buy an attached home if I'm a buyer right now.
And that's a really great point. If you're a house hacker, definitely have condos on your radar, which we always talk about with people. And then if you're an investor just buying traditional, sub $200,000 condos in Aurora, Southwest Denver, we're not noticing any huge increases in inventory. Like, geez, I wish there was, because we would buy a lot more of them.
That's right.
So let's see. The next slide here is actually showing the active listings versus the how much properties were sold that month. So this is the big graph where it goes all the way back about to 2008, where we had 25,000 plus properties inventory, and it just goes all the way from 25,000 inventory down to what we've been the last couple of years, between 3,000 to 7,000. And so something I always like to highlight is jumping all the way back to 2008, when we were at 20,000 plus homes in inventory. Our sold homes were between right around 3,000 to 5,000 properties per month. And then fast forwarding to when the market shifted to more of a seller's market and just been this hot market around 2013, 14 timeframe, or 2012, 2013 timeframe, we're still around 3,000 to 6,000 homes. So there's not been a huge increase in the number of homes sold, even though there's way more demand. So I've got a red line on here. I know a lot of you can't see, but this is actually touching on what we just talked about a couple minutes ago, where there's 8,890 single family homes of inventory right now. Now, this line shows going all the way back. We've not had this much inventory since 2013. Now, last summer, fall time, when inventory actually started peaking some, that peaked, I think, right around 8,000. So this amount of inventory is actually slightly higher. I don't know. I mean, not by much. I mean, maybe 100 or 200 properties, so a very insignificant amount. But it's actually slightly higher than what we saw last year when inventory started building. So, Joe, I mean, I like this graph. You like this graph. Thoughts, words of wisdom?
You know what? The question that I think I talk about it every month, but I talk about it every day. Are we in a bubble? No. All right. Right now, prices are increasing, and there's very few homes on the market. Even still, there's a gap of what we're selling and what's available is very, very small. This is not an indicator of a bubble. This over here, we had this many homes and this many selling, and prices were increasing. That's a bubble. All right. Back in 2008, when you had this huge gap between the number of homes available and the number of homes being sold, yet prices were still going up, that's an indicator for a bubble. Over here, prices are going up simply because of supply and demand. This is an appropriate number of homes to be on the market and have prices continuing to increase. So are we in a bubble? You heard it here first. This month, last month, the month before. No, we are not in a bubble. That's what I love about this chart.
So, Joe, I got trivia for you here.
I'm great at trivia.
Okay, so what is the 35-year average for the number of active listings in the month of May? So this is between 1985 and 2009.
You're supposed to ask me a question I know. I would say 12,000.
You're very close. If this was the price right, you'd win because you're under
$1, Bob. $1.
Actually, it is 16,007 proproperties.
Okay.
And so right around 16,000. So right now we're at 8,900. So basically, if you doubled it and took away about 1,000 properties, we'd be right around the historical average for the inventory for the month of May.
Yeah.
And so as Joe just said, I'm bringing this up because, we're seeing inventory. Prices are not as appreciating as quickly. Doesn't mean we're in a bubble. I agree with you. I see no expectations of the things slowing down. It all comes back to supply and demand. Supply is increasing a little bit, but the demand still outweighs the supply out there.
There's still a ton of people moving to Denver. We see the stats, the population stats, 50,000, 60, 70,000 people move to Denver every year. That's been true for the last 5 years, likely going to be true for the next 5. It's not a bubble. It's just people need a place to live, and homes go up in value when that happens.
And this is a good time. I printed this out this morning, Joe, because Lon Welsh, who's the founder of Your Castle and just a brilliant data mind, he sent out an email, I think it was yesterday, just highlighting some graphs and data from the Wall Street Journal and the Federal Reserve Board with some commentary and just talking about how rates have dropped. So, generally speaking, the 10-year treasuries has the most impact on mortgage rates. And I didn't know they were falling out at almost 1% the past 6 months.
Yeah.
I knew they'd fall, but it's not 1%.
Yeah.
Which, put that in context for us. Is that a big deal, a little deal?
That's a big deal. So let's think about it. If the 10-year treasury was, I think I don't know, I think a year ago it was at 3 or 3.25, and it's gone down by 1%. That's down to 2.25, and I don't have the stat in front of me, but that's a 33% reduction in the 10-year treasury, which transfers over to interest rates. So we've seen interest rates, if you bought a property in the fall, depending on how much money you were putting down, the type of property, et cetera, you might have had an interest rate of 4.875, 5.25. Now for that same property, you might be getting an interest rate 3.875, 4.25. So a couple of points on that. One, great time to buy. Remember, we spoke about inventory is up. There's an opportunity to get a price reduction or a seller concession. Combine that with lower interest rates, gives our buyers a great opportunity to buy a property, not have to pay as much as they would have paid 6 months ago or 8 months ago. That's number one. Number two, if you bought a property 6, 8, 12 months ago, give me a call. Let's review it, because there might be an opportunity for you to refinance. And even though it's been less than a year, there still might be some opportunities to improve your financing. So we've actually had a lot of those this year. We've been reviewing last year's purchases and finding ways to save people money.
Have you seen an uptick in calls and inquiries about refis?
Big time, yeah.
Okay.
Yeah. Which we're available. We want to help. If you're listening and we've worked together or we haven't worked together, give us a call. We'll review it with you. And
so a lot of this data that Lon's done from the Wall Street Journal just talks, it's very, high level national economic data. A lot of it's just, pointing to, hey, the economy is probably going to slow down here a little bit, and there will be a mild recession on the radar, as economists like to say, maybe next 1 to 3 years.
2 years.
Yeah, it's always 2 years.
It's always 2 years out.
But here's the interesting bullet point that Lon shared. He said, historically, real estate prices have not gone down in mild recessions. They just stop increasing as fast.
Yeah.
So I wanted to really emphasize that, because I talk to people almost weekly between conversations and reading the internet forums out there, where people say, oh, well, I'm just sitting on the sidelines until prices drop. Well, you're probably going to be sitting on the sidelines for a long time.
Yeah.
And I think the opportunity cost of not buying a property and having appreciation, debt pay down, the tax benefits, the cash flow from the property, my guess in every model I've run is that's going to probably give you a better return than sitting on the sidelines and waiting for 2008 to happen again.
Yeah, absolutely. 2008, guys, this was a once in a generation transfer of properties into foreclosure. I don't see that happening again. I just don't. There's nothing to support that it's going to occur.
All right. So long answer. Now's a short answer. Are we in a bubble? No. Are we expect prices to crash? No. All right, so this is just one more fun chart I wanted to show and talk about before we move on. This is actually showing seller markets and recession markets, but it's graphed using days on market. So we've seen days on market creep up a little bit. I think we're at around 30 days on market now from this last month. And that's just, because we're seeing increased inventory, so it takes longer for a property to sell on the market. So the average days on market for the last 40, 50 years in Denver is right around 70 days on market. So back in the 70s, when there's a quote unquote normal seller's market, it's about 60 days on market. Then the recession in the 80s, when interest rates were double digits, about 90 days on market. Then the 90s, another quote unquote normal seller's market, was about 50 days on market. And then the 2008 crash, about 100 days on market. Now, if you go to the recent seller's market, which is an abnormal seller's market, we've been averaging about 25 days on market. That's half of what the other seller's markets have been in Denver. So even though we're seeing inventory increases, we're seeing days on market increases, understand that if we take this month and we get rid of the last couple of years, we've still been in historic lows for inventory, days on market, and we're still in an abnormal seller's market. So it's still very much a seller's market, just not quite as crazy is the best way I could put it.
What I like about this, if days on market were to double today from 25 days on market to 50 days on market, that becomes a normal seller's market. Where we're at is last year we were in an insane seller's market. Now we're in that would have been clinically insane seller's market. Now we're just sort of crazy seller's market, right? So even if days on market doubles, inventory doubles, it takes twice as long to sell a home, this is still going to be a regular seller's market. So buy today, because still a great time.
And what was the population of Denver back in the 90s and 70s?
70s, I don't know.
There's a lot less than today,
500,000,
right?
800,000. Yeah.
I don't know the stats.
Yeah.
But it's a lot
less than today.
Yeah. And that's the whole point, is just, another thing to think about is Denver's population has grown and it's continuing to grow. So what does that do? that keeps rents and prices going because that's creates the demand. All right, so moving on to our fun indicator for the month. And this is actually a news article that from 9news.com came around now about 2 weeks ago or so. And a lot of you probably already seen this, but it talks about, the headline is Denver couple accused of illegally running short-term rental businesses through Airbnb. Now, these guys are actually getting like prosecuted, like mugshots of them not looking very happy on the internet.
Yeah.
And so what's interesting about this to me is that they were both, I know one was a real estate broker. I think they both were brokers, or maybe one was a broker, one was an investor. So these guys are in the real estate business, and they've been around the real estate market for a while. And what's happening, guys, a couple of years ago, 2 or 3 years ago, Denver required, hey, if you want to Airbnb out your property, it needs to be your primary residence. And then earlier this year, they actually started making people submit information and essentially sign an affidavit saying, hey, this is my residential property, like signing a document, submitting an Excel bill, some proof that's your primary residence. So, and someone told me about this a couple months ago. I don't do anything with Airbnb personally as far as my own investments because I just want to live in my house and I don't want to illegally run one because that's stupid. But what that happens if I'm signing something and saying, hey, this is my primary residence, and I'm photoshopping the address on there, I sign it, I submit it to whatever Denver County or Denver board that is.
There's a word for that.
What is that word?
Fraud. My favorite F word. Well, my second favorite F word.
That is not my favorite F word.
It's a bad thing, man. Tell the truth.
That's where, that gets you in trouble. That's
big time.
And what I've heard on some backstory on here. So just kind of some other people I've talked to. So take this with, a hearsay grain of salt, is that these people have been warned before, like, hey, you need to knock this off. You need to stop it.
Right.
And then finally what happened was they posted a video to YouTube talking about their house in Stapleton, how they love it there with the parks and the schools and, all the cool restaurants around there. So they just posted evidence saying, hey, we live here. But hey, we've got, I think it was 2 other properties in Denver that are primary residents that were Airbnb. Great. So they're doing fraud, and then they're frankly just being stupid.
Yeah. Really foolish.
Yeah. So guys, just keep in mind, I know those numbers can be attractive. They can be sexy, and there's a lot of people getting away with it, but doing a shortcut like this is not worth it. You're doing something illegal. It's not like a gray area. It's not like you're betting. This is a black and white. You're doing an illegal thing that has major consequences. And I relate this stuff to working out. You want to work out and get into shape and get fit and all that. Cool. It's going to take a couple months to a couple years. You can do it, the normal way, eat well, exercise, good nutrition, all that stuff. Or go out there and take steroids. Yeah, the steroids will give you a shortcut, but there are long-term consequences to it.
That's right.
And same thing on here. If you're looking to build long-term wealth in real estate, I would recommend don't take shortcuts and definitely don't do anything illegal.
Don't break the law, man.
Yeah.
I know so many people that have become millionaires in real estate, and they don't even speed. They do not break the law. If you follow the law, you can be successful in this business.
Yeah. So they just want to really touch on that. Guys, just you see these headlines, you see these possibilities, just please do not break the law. All right. So moving on to our first deal. So this is our deal analysis number 1, and this is a duplex, because this will be fun to talk about because we do not talk about multis very much because there's probably 50 on the market below $1 million right now between duplexes, triplexes, and fourplexes. So there's a huge amount of inventory.
Yeah.
That's sarcasm, by the way. Anyway, so this is actually right on the border of Denver, Aurora, just south of the Stanley Marketplace. Yeah. So it's a great side-by-side duplex, the kind of classic thing you see around Denver. Each side is a 2-bedroom, 1 bathroom. And one side of it was actually recently remodeled. So it was in great shape. The other side needed a little cosmetic repairs, just some paint and either new flooring or to refinish the hardwood floors. So very, light update. And as far as multis are concerned, that is hey, this is an amazing, great shape because most multis have a ton of deferred maintenance and a lot of issues behind the scenes. This, a little bit of cosmetic stuff, and it was all good to go. So this next slide, Joe, we should have a drum roll for this. You know what the next slide is?
Did that work? I'm tapping on the microphone.
Yeah, I don't know if you guys can actually hear that. So Joe and I are actually coming out with a new class next month because we actually, we teach a lot of classes, a lot of stuff together. And we came up with this thing that we're calling the deal quadrant. And we decided to put this together just to teach people and educate people the 4 ways you can go out there and acquire properties. One's not the right way. One's not the wrong way. It really depends on your situation. We kind of are going to go through all the pros and cons of the classes, risk level, skill level, time needed, money needed, and just kind of educate people and know, hey, which quadrants do you want to focus on? So MLS, networking, wholesaling, lead gen are the 4 main ways. Come to class to get a lot more details on that. But this one actually came from networking. So the story behind this is just from one of my colleagues around town. He's a flipper, so he's always looking for properties at a deep discount. And he came across this duplex. Originally, it was basically a for sale by owner, where they said, "Oh yeah, we'll take." It was like something like $315,000 or $320,000 for, which worked for his numbers as far as a flipper to come in there, rehab it, buy it, flip it, and get out of there. Now, once they came back, and that was a handshake deal, or verbal deal. Once they came back a day or two later, write the contract. Oh, well, now he wanted like $350 or $360, or the price went up dramatically, like 30 or 40 grand. He said, "Hey, those numbers don't work for me anymore." But he said, "Hey, Chris, this would be perfect for you or one of your clients who just want to do like a great rental property and then come in and walk in some instant equity." So he passed that along to me. So we hopped on it, went and checked it out, and then just started contacting our clients. Say, "Hey, here's something that came up. Here are the numbers. Here are the photos. Let's go check it out." So this one actually came from networking, which is one of my favorite ways to get deals. You don't see a ton of them this way, but you can see some good deals this way.
I get my very best deals from networking.
Yeah.
Let people know, your neighbors, your friends, your family, that you are open and available for real estate business and you want to do business with them. And we're going to talk way more about that in the class. Networking is such an underutilized way to find deals.
Yeah, and definitely we'll talk specifics of the class at the end, but go out to the Your Castle training calendar, or mine or Joe's training calendar. It's on there. It should be a really fun new class. We're excited about it.
Yep.
All right. So we got this from through networking, went and checked it out, and we had to move fast because a couple things were gone. This was a for sale by owner, and he wanted to just get rid of the property ASAP. More word was getting out there that this property was available. And so by the time we actually went and looked at it, this was just 4, 5, 6 days after, not that long. A handful of days since my buddy passed along to me. And then we got some people interested and went and checked it out. He now wanted right around a $400,000 price, which is still cheaper than comparable duplexes around the area. But couple things. He actually had offers that were higher than our offers. But couple of things that helped us out is, number one, we had a good rapport with him because we actually talked to the seller, typically the seller's agent, in this case, the seller. We actually talk to him. We tell him what we're doing, our background. We tell him our clients lined up and ready to go. And we tell him we're working with Joe Massey, and Joe can come in. And as Joe said, he comes in and close really fast. And so this is one of the situations where I think we did a 14-day close, 13-day close.
It was 10.
10 day?
10 days.
It was really
quick. From the day the contract signed to the day it closed was 10 days.
Was it okay? 10 days.
Mm-hmm.
So it was a quick close, and this is
on
not
a duplex,
and not a cash offer.
Right.
So what we did here was, I think it was a 20 or 25% down conventional.
25% down conventional. Yep.
So we did that, but the way Joe can work fast, besides that he's just streamlined. Talk about the appraisal, because man, $1,500 for an appraisal, Joe. It's a lot of money.
$1,500 is a lot of money. All right. So the normal cost for a duplex appraisal is $800. Normal cost for a single family appraisal is $600. But a duplex, they've got to inspect 2 units. They've got to compare to other duplexes. There's more work. Right? Yeah. So it costs $800, and the normal time to get that back is about 10 to 14 days. So
which is still quicker than other lenders. Normal stuff.
Yeah, absolutely. So 10 to 14 days for a normal duplex appraisal. Well, one of the things that we do is we just say, hey, you know what, Mr. Appraiser, we're going to pay you double or nearly double, but we want to cut to the front of the line. And we want you to go out there today, and we want that report back within 72 hours. Well, guess what our appraisers say? Fantastic. I'm going to make double, same amount of work. They go out, they get back to us within 72 hours with a completed report. So I want to be clear. The client had to pay $1,500 for this appraisal. But guess what the client got in trade? A property 10 days that he didn't have to pay an inflated price for, because you said you had offers or they had offers $10,000, $20,000 more.
Yep.
But they liked our offer because we could close in 10 days. So it cost him $700 additional, but he didn't have to match another offer $20,000 higher. So he saved $19,300 by spending $700 to pay the appraiser to move a little bit faster. And this is something that we use this a lot. And it's a great strategy. And I'm happy to do it on single family homes, investment properties, condos. It works great to cut through the clutter and show the seller we're serious. We want to buy the house, and we want to buy the house today.
Yeah. And I would say, I mean, I'm trying to think, I mean, we probably, do quick closings and rushed appraisals with you. I mean, maybe 1/6 of the time, 1/7 of the time with our properties.
Like, yeah, like maybe 20% of the time, not even 15%.
Yeah, I mean, we, this is not the only time we've done it. We do it because, hey, when a hot property comes to the market or a great property comes to the market, we need to move fast. And a lot of times, because of the way we write the offer, we have our clients prepped, we work with Joe, we got all of our ducks in a row. We can actually beat out cash offers, or we can beat out higher priced offers. Just like, oh, cool. If you guys are going to close quick, man, you got everything. You've definitely got the card stacked in your decks with the highest chance of closing.
Right.
And we do other things, the limited inspection and a lot of other things as well. But the quick appraisal is a huge, huge thing, because if we can do the inspection real quick, it doesn't matter if it still takes another lender 20 days to close or 30 days to close or whatever.
Right.
So just want to highlight that because this is one of the things, one of the cards we laid out that helped us get this deal done.
Right.
And the client was very happy and was happy to pay an extra $700.
Right.
To walk into $20,000 or $30,000 of equity.
Right. Yeah. $20,000 of equity for a cost of $700. I'll do that all day long.
Yeah. Can I give you $700 for $20,000, Joe?
No.
Damn. All right. Next time.
Next time, right?
All right. So now we're looking at the CD, Joe. So I'll let you kind of run us through this.
Yeah.
Because this is your ballpark, man.
Yeah. This is different too, because it's a duplex. So here's our loan amount. This is with 25% down. I forgot 305 loan amount. Not everybody can see the screen. That's the feedback I get from people. They're like, Joe, you need to say the numbers. Interest rate 5.5%, 30-year fixed. A little higher interest rate because it is a duplex. All right. Important to understand that a multi-unit investment property always going to be a little more expensive than a single family. Monthly payment $1,735, taxes and insurance $271. So total payment $2,007 per month, and they put down right at $100,000. All right, that's 25% of that $400,000 purchase price. So right at $100,000 out of pocket. And yes, they did spend $700 additional on the appraisal in order to cut through the clutter and get this done quickly. So very reasonable, I think, to buy a duplex with $100,000 and a $2,000 a month payment.
If I wasn't under contract for another property I'm buying, I would have jumped on this.
This is a great deal.
I mean, because we just don't see this too often, and I'm glad we got under contract. And you know what? A big shout out to our client, because he acted fast, he knew what he wanted, and he could make a decision, which is what you have to be able to do. And he had his cash lined up. He was pre-approved with Joe.
Yeah.
Everything was ready to go.
He was great. This client was amazing because he called. He said, okay, I want to do this. Here's what I want to do. What do you think? We said, great. We can help you. We can help you buy this house. Here's your next steps. We need you to do A, B, and C. By the way, can you come to the office tonight at 6:30 to get started? And he was like, no problem. I'm on my way. Yeah. Right. So he is a serious investor. And if you're listening to the podcast and you're thinking, boy, I'm frustrated because I can't get a property under contract, or, properties move too quickly. This gentleman that bought this property, this is your competition. All right. So just think about that. And there's hundreds of guys out there like him who are ready to move quickly. If you're not ready to move quickly, that's okay. But don't let the market frustrate you, because other people are out there that are ready to move quickly. So this buyer was just fantastic. I would work with him any day of the week.
Oh,
twice
absolutely.
on Sunday. Yeah.
As far as the inspection stuff, I mean, we did the inspection, of course. Nothing major came back. We got a few things replaced. One of the dishwashers broken, got that replaced. The crawl space underneath the property, bunch of stuff, and had that cleaned out. Then one of the furnaces down there was actually sitting on the dirt, so we got that raised up, clean. And I think that was, the main things. Beyond that, I mean, there were definitely, you get an inspection report. There's always things on the inspection report, but we actually got a couple things taken care of by the seller as well, which was phenomenal. So hey, we just want this, and this done, and they're like, cool, we'll do that. Again, that's because we wrote a good offer. We were working with them. We had good communication, and we just said, hey, these are all realistic things that we can ask for. So this is the spreadsheet here. So as Joe said, the client put down 25%. Purchase price was right around 405. Acquisition cost, loan cost, actually we have about 6,000 in the spreadsheet. I think it was more around 10,000 with the rushed appraisal and a couple other things.
Yeah.
So bump it up a few bucks. We put the initial repair cost in there at $5,000. I haven't gotten the exact amount from the client. But like I said, the one unit was already tenant occupied, good to go, needed nothing. That was the only unit that actually needed the dishwasher, and the seller replaced that before closing. The other unit, original hardwood floors, and they were just, needed to be either covered up with something or refinished. And then one of the previous tenants, like kids, had taken markers all over the walls, so that needed a paint job. So
hey, that's custom paint, man. You don't want to cover that up.
Great. I'll bring my kid over to your house and paint a mural for you.
Better look good.
Yes. Oh, it'll be permanent too.
Great.
So about $5,000, we're guessing this repair cost might go up a little bit if he does a couple other things. Just kind of, I'll tenant proof this, go and take care of this. Who knows? But about $5,000, give or take, a couple grand. Interest rate about 5.5%. We put the rents in there at $1,500. They'll come in actually about $1,500 to $1,600. We put $1,500 in there just to be a little bit more conservative. So total rental income about $3,000 a month. His real estate taxes, about $2,000 in taxes. I have $1,500 in there for property insurance. It's actually like $1,200 a year in property insurance. Repairs and maintenance, we got about $3,000. So for standalone properties, we like to use 8%, just because you don't have an HOA to take care of a lot of the exterior maintenance for you. Like I said, this duplex, it was in good shape. Water and sewer, we put in about $1,400 for the year. Beyond that, the tenants pay for all the other utilities. And the water and sewer might be a little bit lower, but again, $100 one or the other should not destroy anything for you. And in my opinion, nor should you really care about it, because that's just the cost of doing business.
Yeah.
Okay, so jumping, let's go back to the right slide here. All right. What is going on there?
I'm not touching anything on the keyboard. Okay.
No,
there you go.
that's something I did. See, I added those two red bars earlier to the PowerPoint slide, and now slides are jumping around.
Right.
So this is the second tab of Joe's spreadsheet. I think it's the cash flow tab.
Yep.
These are
your results. Yeah.
Yeah. So we got our net operating income about $27,000 for the year. So that is gross income. $3,000 in rent times 12 months minus vacancy minus expenses. So about $27,000. Less the mortgage payments of about$20,600 for the year. So $1,725 for the month. And then Joe's numbers in the CD were higher because we have the taxes and insurance coming out of the net operating income. So our annual cash flow is just about $6,500 a year. So Joe, when you see a duplex that requires minimal work, that produces a $6,500 year cash flow and is a 6.6 cap rate, what's your reaction?
When can I buy it?
Exactly. Because a lot of the multi cap rates we see, assuming we're not like in the downtown cool areas, they're between about a 5.5 to about a 6.5 cap rate on the good side. They're usually right around a 6 cap rate. A lot of times those have deferred maintenance, need a lot more work than this property. So the fact that this came in at 6.6 cap rate, and again, take that number because he is self-managing it. Now, if he hired a property manager, it would drop down to 6.2, 6.3 cap rate probably, which is still a much better deal than we normally see out there. So cool. That's how the rental was. I'd buy this. Joe would buy this.
I would buy this all day long, man. Yeah. This is a fantastic transaction. And again, buyer knew exactly what he wanted, was ready to execute, ready to pull the trigger. Just a great transaction all around. I could not be happier. The seller was thrilled too. The seller was happy because he was 1031ing out to buy a different property. This is really what I like. This is a win-win for everybody. Everyone was happy.
Yes. So there's actually a very interesting twist on this property as well. I don't think we actually talked about this in podcast yet or anything. And I think we'll start talking about it now, but this was actually had a great potential for a house hack. And not just because it was a vacant unit and we could have done a 3.5% FHA loan, because our client, I think he already owns one investment and has another and has his primary. So he owns 2 properties in Denver, so he can't use FHA.
Right.
But there's a program, Joe, that allows, not getting into details, but 5% down on some multis around town.
Yeah, we have some plans that we could do 5% down on a multi-unit. Depending on your income, you've got to qualify for it. Even if you own other properties, this is a conventional transaction that we have. Shout out to one of our viewers who actually ran across this and sent it over to me and said, hey, is this a legit deal? I had to do a little research on it. And yeah, we actually have this available. So it's a terrific transaction. There's some restrictions, right? You have to meet certain income requirements and whatnot. But really a terrific transaction if you wanted to do this as a house hack.
Yeah. And if you want to know the specifics of that, because it's lending, there's a lot of nuances there, contact Joe or come to one of our house hacking classes, because we run through an example on there and we can go in some details. So, one of the options we looked at this, and we actually, besides from the great rental numbers, what got me really excited was like, oh, this would also work actually as a house hack at 5% down. So we're using the exact same numbers here of the purchase price, the acquisition cost, all that stuff. But instead we change it from a 25% down payment to a 5% down payment. So the two big things this does here is the cash to close drops significantly with the closing costs, cash to closing, the repair costs. He'll come in right around like $31,000 to $35,000 for a duplex that you can live in for 1 year, then move out and rent.
That's insane.
Yeah.
I mean, buying a duplex for $31,000 or $32,000 is just insane.
Now I put, this was what I think a month ago we closed. I put in 4.5% interest rate. I assume that was
probably about right.
Okay.
Yeah, I'd have to double check on. It's the unique.
It's
program.
close enough though,
it's
right?
Close enough. Yeah, it might be a little less.
And then we just did the same thing. Rents are the same, $1,500. All of our expenses are the same, because we're analyzing this not so much while they're living there, that 1 or 2 years, but more from the long-term aspect, because you move in the house hack because, hey, you get that amazing lower down payment and you get that much better interest rate. Then after 365 days, you can move out. Because you move out before then, that's called loan fraud, and you don't want to do that. You move out afterwards, convert to a rental, and great, now you own a rental property with a lot less cash down. Now, here's the downside to that is it makes margins tighter. So here is the cash flow tab on Joe's spreadsheet of running that 5% down house hack. And this is what just blows my mind. So we got our net operating income about $25,000 a year, and then less our mortgage payments of about $23,400. I think in the previous one we were like $20,000 a year in mortgage payments. So hey, we're paying a little bit more in mortgage payments.
You borrowed more money
because we borrowed more money.
Yeah.
But here's the crazy thing: it actually positively cash flows about $1,700 a year. So I mean, that's what $125 a month.
Yeah, not a
so
lot.
You're not retiring off of this, but oh my gosh, you got a cash flowing duplex in Denver at 5% down with minimal cash, and you still got a bunch of other money in the bank. Oh, I wish I did this when I was in my 20s and I was single.
Yep. And don't forget, what happens if you sell the property in 5 years? All right. Including the value of going up, including your cash flows, paying your capital gains, you're going to be making a 38% year-over-year return. All right. That's where house hacking really, really sets you apart, is because you don't have to put a lot of money in and your returns just explode because of that amount of leverage.
Yeah. So, I think I'm just looking through the notes here. That's everything I wanted to touch on. Anything about this deal before you hop on?
No, it's a fantastic one.
So now we're moving on to house hack number 2. And this is actually a condo right near Sloan's Lake. So this is a 3-bedroom, 2-bathroom that we got for just around $400,000. And the reason we liked it is it was actually a great layout. Like, I walked in there, our clients had found it, and I had just basically set the show and went and looked at it, and I really did not even dig through the MLS before we went and checked it out. Walked in there, I was like, wait, I'm confused. And I realized, oh, there's a basement. So it's actually a townhouse style, which, you don't see those in condos very often. Actually, I really like those styles. So it was a townhouse style condo that actually had a attached garage to it. So a 1-car attached garage. We actually park a car in there, plus have some storage room. And that walked connected right to like the back of the house, right where like the hallway, living room area. So great layout with a garage. And also, man, a great location. I mean, man, Sloan's Lake, what a dump, right?
Oh man, I love.
I never go there.
Yeah, I don't live over there, but when I go, I'm like, man, this place is cool. Fun people, fun atmosphere. I love it over there.
And I mean, so what's happening in that area? I mean, you got Sloan's Lake, you got, the areas are transitioning. What's your prediction for the whole just general Sloan's Lake area, northeast, southwest of it over the next 10 years?
I think it's just going to continue to be a hot area. Values are going to continue to go up. People are going to continue to want to live there.
Yeah. And this is just on the west side of Sloan's Lake. So I think there's going to be a lot more growth over there just because those are, generally speaking, the lower priced areas. So this person wanted to buy a place. He recently moved to Denver, I think a year or two ago, and they're going to house hack, buy this, live in it for a year or so, move out to their area. And their goals are, hey, they want to explore some cool parts of Denver. So they actually want to enjoy it while they live there. And they also want to buy areas where, hey, cool, and Denver's going to make sense. And I'm going to kind of put my chips where I can take a guess where I'm going to see higher than normal expected appreciation because those neighborhoods are happening over there. They're changing over there. And I 100% agree with that.
Yeah.
So looking at the deal quadrant again, MLS, networking, wholesale, lead gen.
Wait, let me guess. MLS. Bam.
Bingo.
I knew it.
Yes. So got this off the MLS, and the way we got the deal, well, before I move on to that, the way we got that deal, we'd actually looked at a couple other properties with this client. I think we'd put in one offer, didn't get accepted. Actually wasn't the right fit for the client anyway. And then this one popped up. We went and checked it out. Actually been in the market for, I think, a week or two. We went and checked it out on Sunday afternoon. We had the offer in by Sunday afternoon, and we came in about, I think about $10,000 below the list price. And then they said, hey, look, we like your offer, but we got another offer that came in actually a couple bucks above our list price. But again, since you guys wrote a really tight contract, we know who you are. I've done it. This is a listing agent. I've done a deal with Joe Massey in the past. Hey, if you guys can come up to this point, which was actually a little below the listing price and still below the other offer, great. We got the property contract, and we went to our buyer and said, hey, here's the deal. Here's the situation. We're going to have to come up, $7,000, $8,000, $9,000 in price. And he was like, yeah, let's do it. Of course, no brainer. Yeah. Which I was like, good. That's the right attitude, because if people get tripped up over that, you're going to have a hard time finding a property, because you don't make your money by saving $8,000 in a loan right now. You're making money by buying a property and holding on to it for 10, 20, 30 years here in Denver. And Joe, the rule of thumb we use is what, for about every $5,000 more in loan, it's about an extra $25 a month.
About 25. Yeah. It varies depending on interest rate, et cetera. But every $5,000 increase in your purchase price is about a $25 payment. And
so that's a great way to reframe it. So great. Let's just assume we're going up $10,000, even though we're not going quite that much. An extra $50 a month.
Yeah.
Frankly, do you care about $50 a month?
No.
For investment?
If I care about $50 a month, I should not be buying real estate.
Exactly.
Right? If that is enough to make or break me, I'm not in a position to be buying real estate right now.
Yes, amen. So going on to the CD here. So we got the property under contract, and we did not do a rushed appraisal, but we still wrote a very quick close. I think it was about 21 days or so.
Yeah, it was regular.
Well, that's regular for us, not regular for a lot of other people,
right?
For other agents and lenders. So walk us through the CD here, Joe.
Sure. I have to go back and look. I want to say, did you do 10? Yeah, 10% down, because it's 10% down. Super low interest rate, 4.125. Principal and interest, 1744. Let me show you what I love about this. Mortgage insurance, $57 a month. So one of the things that we offer at Castle & Cook Mortgage, we have preferred relationships with a lot of our mortgage insurance providers. And so we can get you reduced mortgage insurance as compared to a lot of other lenders.
Oh, so, really?
A lot of people think, mortgage insurance is going to be $200, $300 a month. Well, it might be if you have issues, but this is an individual that has great credit, lots of positives, super low mortgage insurance. $57 in mortgage insurance for a $400,000 purchase. A lot of people get nervous about mortgage insurance. Please don't. Sit down with us. I'll show you. It's just a way to get you into the property and not have to save up for 20% down. And he's only going to have it for 7 years. Then it goes away. Taxes and insurance, that total monthly payment, about $1,986. So he invested a total $46,000 into this property. So really, again, minimal investment, minimal monthly payment. I think just a terrific transaction. And again, a client that was fantastic to work with, knew exactly what he wanted, followed all the steps. Hey, we need your paycheck stubs, your tax returns, your W-2s. Great. Send all this stuff in. It was just great to deal with.
Yeah. So going to the spreadsheet here, this is the same spreadsheet, but we've put in the numbers here for the house hack. So house hack near Sloan's Lake is what it's titled. We did a 10% down payment. Now you could have done 5%, but we want to do 10% just to, I think, make the numbers work a little bit better. The purchase price was right around $400,000. Now you'll see here, I've got a negative $2,000 in acquisition cost. That's just kind of like a nature of the beast with the spreadsheet, because this is an investing spreadsheet. And so if we do a lower than 20% down payment, it really jacks up the loan cost. Yep. So I offset the loan cost there. So it's about $9,000 or $10,000 in all-in closing cost of, loan costs, inspections, appraisals, and all those other things that add up at the closing table. So altogether, the total investment is just about $50,000. 4 1/8 interest rate, 4.125. And so I got about $2,000. I have $2,000 a month in rent right here. And of course, he's living there right now. So he is not getting $2,000 a month in rent, but this is what we're expecting once he moves out. And actually, the plan is it's him and his, I think, fiance. They're going to move in there. And the way it works out with the layout's really sweet is since it's that up, down, or not, this is a 2-story condo. There's 1 bedroom upstairs with kitchen and main floor or living area, bathroom, garage access, walk down the stairs, washer and dryer, hallway, utility closet, then a gigantic bedroom, and then another bedroom out back. And both these bedrooms, they're like, about garland. They both have gigantic egress windows. The only thing that the big bedroom technically needs is to have a closet put in there, or wardrobe, to be a conforming bedroom, but it has electrical, HVAC, egress windows. So a little wardrobe or closet, no big deal. So they're going to, while they live there, actually live in one of the bedrooms. I don't think they quite decided what they want to do in, but they were either rent out 1 or 2 bedrooms. I think rent out 1 bedroom. And down there in Sloan's Lake, nice area, they'll probably get $700-800 a month in rent from by renting out the room by room. So $800 a month, that takes out a gigantic chunk of their mortgage payment. Probably about half, almost half, Joe?
Almost half.
Yeah,
a lot.
So great. I mean, just a textbook example of a great house hack where they get to live in a cool area. They get to still have good privacy. They're not having like 5 roommates with them, good balance, and their mortgage is almost cut in half because their tenant is paying for it. So when they move out, looking at comps around the area, I think they can get between about $2,000 to $2,200 a month in rent. If you guys been in Sloan's Lake, there's new stuff, there's old stuff, there's all sorts of stuff over there. So I put in probably the lower number, just again, be conservative. So about $2,000 a month in rent in a year. It's probably going to be $2,000 and $2,200 just based on looking at some comps on Zillow and other websites. So their taxes are about $1,650 a year. Property insurance, it's a condo, so it's very inexpensive, about $350 annually. And repairs and maintenance, we put in about 5%. Since we're paying HOA dues, this is one of the pros to HOAs. They lower your insurance and they actually lower your maintenance and repairs, because who's paying for the exterior, the roof, the siding, the pavement, the sidewalks? It's the HOA. So their HOA dues are about $3,900 a year. So altogether, this gives them a net operating income once they move out of about $16,000 a year. So that's their rents minus the expenses. They're left about $16,000 and change, less their mortgage payments of about $21,000 a year. So their annual cash flow before taxes will be a negative $4,800 a year, or about $500 a month, right?
About $500 a month. Yeah. Well, $400 a month.
$400 a month.
Yeah,
okay.
sure.
Yeah. That's why I always ask the lender to do math, because
I'm pretty good with math.
I know.
Yeah.
Like that's why I ask you.
Yeah.
So they move out and they're making a negative cash flow. Red flag, right?
Oh my God, I would never do this deal. Worst thing ever.
So
are you picking up on my sarcasm?
Oh, that's sarcasm?
That was sarcasm.
Oh. Yeah, I agree with you. I mean, or not, I agree with the sarcasm, I should say.
Right.
I mean, so here's the deal. Could they have bought a place for better cash flow? Absolutely. But again, this is where house hacking comes into blending investing and blending in their personality.
Right.
And so, as I said before, they wanted to live in their plan is to house hack some different neighborhoods around Denver to get to know them. Cool. Live a cool spot here, live a cool spot here, live a cool spot here. And the thinking about this just kind of takes up to the next thing that all investors need to look at is what type of return on investment they're looking for. And this is something actually we're coming out with a whole other new class on this. We're actually going to dive into deep details on this. So make sure you check out, this is a different class in the deal quadrant, because a lot of times people just look at cash flow. That's only one of the 4 ways you make money in real estate. Is it the best way? Well, depends on the investor. It just depends on their finances, their goals, their timeline, all that stuff. And they're like, hey, cash flow is not the most important thing for us. We can't be taking a gigantic loss every year, but again, a couple bucks a month, a couple $1,000 a year, we don't care, especially since depreciation will probably about offset that.
Right.
And they get to keep a lot more money in the bank from the reduced down payment. Cool. So they want to live in these cool areas, and they're going to kind of be on the, the near the cool areas on the transitionary side, so they can hopefully get properties at a lower price, relatively speaking, in the neighborhood, and then ride that next wave of appreciation, whether that happens next couple years or after the market maybe slows down a little bit and happens in 5 or 10 years. They're playing the long game here. Like, hey, if we buy in Sloan's Lake, is it going to be better and more expensive 10 years from now? Yes.
It will be. It's the fact. It's a cool area. People want to live there. They're putting in new development. You've got the lake. The mountains are close. It's going to increase in value.
Yeah. And so that's their plan. So they're not just looking at straight cash. They're like, hey, if we can get a great return on appreciation, increased rents, all sorts of exit strategies if we ever wanted to sell, all sorts of stuff, and that hits their return profile. And I 100% agree, because they're a young couple, probably, 30-ish or so?
If that.
Maybe younger.
Maybe 28.
Yeah. Probably a little younger than 30. And they're just looking for a great long-term investment, and this fits the bill. So their 5-year after-tax return, assuming they sell in 5 years, is 21%. That's even with a negative cash flow when they move out.
That's right.
So I love this deal.
I do too.
And I think this is a smart play for house hackers. And that's what we often talk about when we meet with them. I don't think we talk about on the podcast too much. Is like, cool, you're going to buy a place, because a lot of places with the best cash flows are usually the places people often don't want to house hack. But buy a place and things like this where, hey, cool, we know this is a hot area, high demand, potential for, growth greater than what we're seeing in Denver Metro. Cool. That's a very good long-term risk.
Let me tell you,
long-term plan with low risk.
Yeah. Let me tell you what I like about this. All right. The numbers don't say, oh my gosh, this is a no-brainer. You should totally buy this. But you know what? These guys didn't buy just simply on emotion. They bought on where they want to live, right? Which is cool. If I bought based on just simply the numbers, my house wouldn't make sense. But you know why I bought it? Because that's where I want to live.
Yeah.
So these guys didn't buy simply on the numbers. They bought on, hey, the numbers are okay, but we know we want to live there, and we know we're going to make money in the long term. Perfect. It does not have to be buying a property in North Aurora and living there and being miserable. House hacking does not have to be miserable. Not that North Aurora is miserable. I live in Aurora, by the way. Not that North Aurora is miserable, right? But house hacking does not have to be a punishment. This person can live in this property, and I guarantee if we plug this into the house hacking spreadsheet and he does this 4 more times over the next 4 years, there will be a word for him after 30 years. And do you know what that word is?
Probably starts with a W. Wealthy?
Wealthy or millionaire.
Yeah.
Yeah. All right. So just because these numbers don't look like the greatest home run in the world, that's okay. Everything really comes down to multiple reasons about why you want to buy. The numbers, the emotions. Is this where I want to live? Don't be afraid to do a house hack in an area that's not perfect, but you enjoy living there.
Exactly. And so the other new class coming out is called the Return on Investment Quadrant. We actually dive in the 4 ways on how to the 4 ways you make money in real estate. Because a lot of times people get hyper focused on cash flow, which is definitely an important thing, but it's not the only thing. So we're actually dive into understanding all those 4 quadrants and run deals through there. Joe's in the process of updating the spreadsheet. We're in the process of finishing it out. It's going to be a really cool class and a powerful way to look at properties, because it's not just cash that makes you money in real estate. So we don't have that class on the calendar yet, but we should have the next probably week or 2. So just keep your eyes out on the email list, the calendar, because we will definitely let you know when it comes up. And also keep your eyes out for a new updated edition of Joe's spreadsheet.
That's going to be cool.
Yes, it really is.
Cooler.
Good save. Okay, so that's it for the Roundup webinar. I appreciate you guys listening. Got a couple upcoming classes here. The first one I'll draw your attention to is the new class, the How to Find Deals. And this is the deal quadrant that we talked about. This will be a great class, not just going over those 4 things we talked about: wholesale, networking, MLS, and find your own lead generation. We go through the pros and cons of each. We go through how to work with a lender, what type of lending works in those situations. We go to when to work with an agent, when not to work with an agent. So it's meant to be a very high-level educational overview, with the goal of helping you know exactly what type of property you want, and then knowing what quadrants, what sources of deals for you to focus on. So come to it. The first one is going to be Tuesday, July 16th at 1 p.m. If you can't make it, don't worry. We'll be teaching the class again. And then we got a house hacking class coming up the next day on Wednesday, July 17th at 6 p.m. And then, wow, the next day we've got the BRRRR strategy for buy, rehab, rent, Refinance and Repeat, which is a really good way to acquire properties, happening on Thursday, July 18th at 2 p.m. If you guys can't make those classes, we'll teach them again in the future. These are will be some of our core classes going forward. So check the notes, check the Your Castle calendar, check my calendar, check Joe's calendar for the details.
Absolutely. Would love you guys to come to any of those classes. Really enjoy teaching those and just look forward to seeing you.
All right, guys. Well, that's it. Again, my name is Chris Lopez. I'm a real estate agent here at Your Castle Real Estate. I help people with buying house hacks and buying rental properties. So if you need help on finding a property or adding to a portfolio, give me a call, email me. I'd love to talk with you. And then if you need help financing and buying those properties, then reach out to Joe Massey, who is a senior loan officer at Castle & Cook.
Absolutely. Would love to chat. You know, we do a lot of these transactions with Chris, a lot of investors, a lot of house hackers. We know all the ins and outs to help you get under contract, help it make a very good financial choice for you. So would love to chat anytime.
Thanks, everyone. Thank you, Joe.
Thank you, Chris. We'll see you soon.